Good morning. Once again, I'm Safia Quinn, your investor professor. Today, we are going to talk about stock market corrections. Okay, that has been heavy in the news, and we kind of really need to discuss it so we can start to understand what is actually going on currently. Okay, so a stock market correction is it's a very healthy reaction to what's going on in the economy or in government or just in your everyday experience. So a stock market correction is a decline of 10%, but it is less than 20% because remember we talked about the rate of return, and when stocks are starting to fall into the 15 and 20%, you are getting into a bear market. Okay, which is different than a correction. So a correction is a decline of 10% or more, but not more than 20%. Okay, so it's kind of like that little in between space. So why do stock market corrections happen? There are about five main reasons. One main reason, and the one that we're seeing, is overevaluation. So stocks that rise get these crazy high. If anytime you hear oh, it broke its 52-week high, it broke its 52-week high, or raised above its 52-week high, know that that is a ping for an upcoming correction. Okay, so when stocks are going really high, that means investors are getting a lot of profit. The economy and the market wants to correct, right? We talked about that. Market concerns, which is truly what we're in now, is fears about inflation, fears about the interest rate, and our economic slowdown, fears of economic slowdown, which with all these layoffs, right, there is definitely fear of economic slowdown. So that is a legitimate fear that is actually fueling this correction that we're having. Geopolitical events, that is wars, that are trade tensions, and political instability, which we are seeing around the globe, right? But I think we always kind of have those geopolitical types of issues, but it's something there that can be noted for stock market corrections. The Federal Reserve actions. We talked about the Feds. We talked about how they are very instrumental into setting the interest rates. And when they spike it too high, right, they can slow growth and impact stock prices, which we talked about. And market psychology. Just how do you feel as an investor, right? Talking to you guys in the comments, I feel like you guys are very, like I said it before, very risk adverse. You really don't want to take on risk, right? But if you're feeling like that, then a lot of people are feeling like that, right? So that is a market psychology. Because remember, we talked about the stock market wants to go up. It's our actions and sentiments that are weighing down on the volatility. So, how long does the stock correction last? It usually lasts between 3 or 4 months. It feels like it is so much longer, but it usually lasts around 3 to 4 months. And the average decline is about 13 to 15%, which is a lot, right? Which is a lot. It's right up against that cusp I told you. If you over 15% into 20, cut it loose. And recovery time, though, is 4 to 6 weeks before the market will start to bounce back. Some examples of some corrections that we've seen very recently. In 2020, the market crashed, right, due to COVID-19, but it recovered in 5 months, recovered on to make record gains. And in 2022, the S&P dropped 13%, which was a huge thing early in January due to the interest rates. Okay, so let's talk about some of the investments that you can have and that you may have that are resilient to the market corrections. So tech stocks hit very hard. When there's a correction, you will see that tech stock stocks like Nvidia, Google, Meta, a whole bunch of tech stocks, right? We can just name them. They hit the hardest because they are so like inflated. They're like inflated. Like people want to like worship tech. Like they're just so inflated that when it's a correction, they get their heads chopped. Rightfully so. Next is blue chip stocks. Now, these are our stable stocks, and they normally take a moderate impact. And I'm going to show you guys in the next video. I purchased some more blue chip stock. My favorite blue chip stock, which is Microsoft, I purchased more at this stock correction time, and I'll show you guys that. Bonds and gold. If any of y'all sitting there with a gold bullion, let us know, okay? Because bonds, which is treasurydirect.gov, so you get your bonds, not your T-bills, right? Because those are short term. Your bonds, they often have, they're often a safe haven. They're not affected by a stock market correction because they are not backed by the stock market. That makes sense, right? And then crypto and speculative stocks, they can drop. We already know that crypto will go up and that crypto will come flying down. So crypto is a very volatile investment, and they are hit hard by corrections. So how do you invest, right? How do you invest during a stock correction? First thing, stay calm and avoid panic selling. Avoid panic selling. The correction will only last a few months and the market will recover. Okay, that's the first thing. The second thing is my favorite advice, which is buying on the dip, which is exactly what I did, and I will show you guys. That means when the stuff is low, everything low is bleeding, blood in the streets, we cashing out. The third thing, diversify your portfolio. If you know that stock market corrections hit tech stocks, maybe you shouldn't be so tech heavy, right? Diversification is a shield for you. And focus on quality stocks. Those are blue chip stocks, those are high dividend stocks, and those are defensive stocks, okay? Those are considered to be quality stocks. Those are stocks that you're familiar with, companies that you're familiar with. Those are companies that have legacy history in the stock market. Now is not the time to invest in something that you don't know about, that you just heard on something, okay? That's not the time for that. And lastly, hold cash reserves. That means stop that buying, increase that saving, okay? So those are some things you can do during this stock correction time, okay? And honestly, just ride the wave. Save your money, buy on the dip, ride the wave.